All right, well, good morning, everyone. Let me get this into presentation mode here. There we go. Good morning, everybody. It's Brynne Kelly and Mike Korn. He's a little tied up right now and will join us hopefully in a little bit. And I can't wait to have him on because he's always such a good sounding board. So today we're going to go over the natural gas inventory numbers and then kind of try to approach what's been going on in the natural gas, especially in February and March contracts, and especially this week. So let's get right to it. We just had the natural gas inventory number come out for week ending January 11th, and it was a draw of 81. The market was expecting 84, so right there within the range. The interesting thing is that puts us now at an inventory level of 2533, which is just slightly above where we were in 2013, 2014 winter season, which is kind of the one that everybody likes to look to as far as analogs and whatnot. However, it's so interesting because if you look at, and I like to, this next chart, I like to kind of keep track of cumulative draws out of storage since the start of the season, which was the beginning of November. And you can see on the top in the black line, that is the 2013, 2014 year, all the way down to the bottom, which is this year, and the total withdrawals for the season. We're only half of what we drew out in that big year that we had the polar vortex in. And shockingly, even just well behind even last year now, since we've gone through these last 4 weeks of really mild winter weather. And the comparables for all of these other years, and you can see it week after week in this draw table by year, we just continue to lag way behind prior years. And so as a result, have been able to really reduce the storage deficit that was such a big story at the start of the season, and kind of, you know, forming the bull case for this winter. And so far we've drawn around 68 on average a week, which, you know, is so far behind any of the previous 5 years. So what does that mean, right? Because now here we are. Is that bullish? Is that bearish? How do we frame up these inventory levels and these numbers that we see coming out each week? And that's a lot of what we're going to talk about today. And hopefully Mike will be able to join me a little bit later for some of it. You know, overall, the natural gas system itself is not short. The issue is always deliverability capacity on any given day. It's not as if we were just sitting here waiting for storage to go to zero and then natural gas would be worth infinity. It's more about how does the supply and demand picture line up on any given day. And what I mean by that is, you know, people who have storage contracts and people who have pipeline contracts, there's only X amount of capacity to withdraw on any given day and to move the product through the pipes on any given day. And there are times when supply certainly exceeds that capacity and we see prices really bottom out. And we see that a lot in the Permian, right? The supply is just so much greater than takeaway capacity, than demand, than storage availability. And so you see prices, move to the opposite of scarcity, I would say, and just really bottom out, because that is a picture of a supply overrun, not scarce. That's scarcity created by supply. On the other hand, we have scarcity created by demand, and we see that a lot on the East and West Coast. On any given day, the demand exceeds the daily available capacity. And so in order to allocate those resources, prices move up to demand scarcity pricing. So the actual level of inventory guides overall market sentiment, and certainly production guides the overall market sentiment, and it helps either keep a floor or a lid on markets overall. And it especially guides, future, when people are looking at hedging further out on the curve, their comfort level on price levels based on sort of the overriding sentiment in the market. But it doesn't necessarily guide within the month, within any given day, a scarcity situation, because we've seen price levels jump at all inventory levels at any particular day. We've seen it in past years, and it's very interesting because if you look, this is sort of a historical, I show this chart a lot. It's a historical comparison of cash prices by year at Henry Hub. And in the red line, we've kind of started out here, 2019. We've got cash prices so far through today. But if you look at the end of 2013, so way over on the right in the gray line, that was, before really the weather had hit, started to hit a little bit at the end of the year, but, it was still an overriding bearish sentiment market. We had inventory levels higher than we did at this year. And then all of the sudden, if you can see, we transfer over here and move into 2014. And really, this is mostly February, where we saw Henry Hub prices on certain days spike up to $8 and $9. I think a lot of people remember that. And that was a really fun year for some and terrible year for others. And I just want you to keep this in mind as we go a little further. So, we weren't even here at the end of 2018 when prices spiked up to $4.50 and $5. We weren't pricing there because there wasn't any gas in the ground. We moved there because we had cold weather that was taxing the system. And then, the weather just completely reversed and we backed off of that. So here's where inventory stands. The green line on the left is by region, and that's current inventories compared to all the other years. And I think a lot of people like to look at this salt inventory level as kind of their Cushing of natural gas. And that is really what's changed and really put this selling pressure onto the market. And that's fine, except for things are a lot different now than even they were in 2012 and 13 from the standpoint of coal plant retirements. And if you think about where this salt storage is, it's down in the Southeast region, especially Texas, where they've had the most significant coal plant retirements and rely on natural gas for power generation much more. So certainly this mild weather had an impact on that. but that's a fluid situation and just as easily, could change if especially we get into some freezing type levels down in the southeast, when all of a sudden people have their electric heat on. We just haven't had, the thing is, this just has not been normal weather. This has been extremely mild. So looking forward, I think, we've sort of moved through all of those really mild weeks. I mean, it's just been pathetic withdrawals from storage. And that's what happens when it's a weather dependent commodity. But now if we look ahead, so we've had 10 weeks now that we have in the books for this official storage season, and we have 12 weeks left. You can see what the futures look like. That's kind of in these dark brown draws for the next 2 weeks, where they settled last night and kind of, what the market is predicting based on their models, and then the year-end futures. And so based on current inventory levels and end of storage futures, it would imply that we have a draw of around 93 a week for the next 12 weeks. And, that is possible, given Mother Nature. So, I find it hard to hang my hat on a trade just based off of this picture alone. It's easier at the start of winter when comps look, when there was such a big deficit. There's so many unknowns that it's kind of easier to build some bullish market sentiment. But now here we are with just the February contract left and about to expire in I think 2 weeks, a little less than 2 weeks. And the market action this week has been really crazy. Not that the market action, we haven't seen a lot of crazy action this winter, but certainly this week. And it seems like overnight they buy it and then, kind of come in during the day. And there's just been some really crazy reversals. And I kind of wanted to talk through why I think that's happening and a different way maybe to think about natural gas, some of these futures contracts, especially the winter months. They trade very similarly from a logic standpoint, the way electricity does. And so I thought it would be interesting to kind of talk through some of that and the sort of the predictions and the probabilities that people are using, and how those are changing and what some of the noise has been out there this week. And hopefully it might just give you a different way to, and who knows, maybe you guys are all running these models already yourself, but, instead of talking about open interest and storage numbers, we're now to essentially the last big winter month on the board. Certainly we have March and we'll deal with that when we get there. But, from a overall cooling heating degree standpoint, February ranks much higher than March. And so, and even, from a forecast standpoint, it looks like that's where we're going to see our winter this year. So there's, kind of a lot being put on this February contract.
Hey, Brynne.
Oh, hey, Mike. Oh, good. Hey. Oh, perfect timing.
Yeah, I'm listening.
Excellent. One of the things, just as a fun fact, that I love about Mike, and I'm sure people probably don't know this, way before he ever, back in the day, before he ever got involved in the whole, in CME and in this world, in the world of trading, Mike was a teacher. And I love that about him. That's why I like working with him and talking through stuff. He always seems to pull out the kind of maybe the concept that I'm trying to get through. So anyway, he's a great teacher and he's retained that skill. So just
thanks for the kind words.
Yeah. So here is, I have two contracts up here. I have Henry Hub for natural gas, and I have ERCOT, which is a Texas electricity futures contract. And I bring up the two of these because, I was kind of hearkened back to this past summer when I was getting involved in all of the ERCOT craziness when the summer futures were running way up, and going through models that everybody was using to kind of justify ERCOT August futures trading. I can't remember if it got up to $300, but certainly above $200, and what the logic was in that. And I was reminded of that kind of this week when I was thinking about Henry Hub. So when people are looking at February futures, they're looking at that as a monthly price. And then they're backing into it to see if they want to go to delivery at the monthly price, or they prefer going to delivery at the individual daily prices. And that's, of course, the genesis of index futures and why they trade. It's a futures contract that settles between the difference of the monthly index and the daily. And what people are looking at right now, and why we're seeing such sort of big drops and moves, is going back to the concept I was talking about earlier. There's always an anticipated number of constrained days where the system will be constrained. And it's very much more magnified when you talk about basis locations. And I think we've talked about Boston, which is Algonquin, and we see, how sometimes we see prices jump up to above $100 in really constrained cold weather, and on the West Coast. And so it's less of an issue at Henry Hub, unless the weather hits at certain, parts of the country, and then you're dealing with either freeze-offs in production, or you're dealing with decreased flow ability, because as you get later in the season, things just get less pressurized as storage caverns are lower. And so the operational capacity of different systems are less. And so there's 28 days in February, and people are running their models and looking at them all day and saying, how many constrained pricing days based on this weather forecast, that weather forecast, probabilities, historicals, do we think we might have in February? And as an analog, even this last February, in January 18th, I guess it was in the month of January was the cold month in 2018. We had 3 or 4 days that priced around $6-ish, or definitely above $5. And in 2014, in February, we certainly saw 3 or 4, maybe a few more days in February that priced over $9. And so if you want to use that as maybe your worst case scenario, or your guide when you're when you're looking at how to interpret these weather forecasts that are coming out, right? You could say, well, there's a probability that we could have 4 constrained pricing days. We certainly saw them earlier in the season. And let's say those price out at $5.50. And the rest of the days are normal, so unconstrained, and those clear at an average of $3.25. You can kind of see how people are backing into where futures are trading. Yesterday and Monday, and even Sunday night, might have even been Friday afternoon, there was clearly a higher probability of more constrained days, or constrained days at a higher price. And then yesterday around 11, there was a little bit of a forecast model update, and it kind of it eroded the confidence level, I would say. I mean, I'm not a weather person, but the people that gobble this changes in every output model. They're certainly building confidence or reducing confidence. And I would say you could tell that they took down those that kind of expectation of constrained price days or any at all. And the bone of contention is some below 30-degree temps down in the Southeast. That is where the salt storage is. That's where so much of our gas demand is from a power generation and consumption and industrial standpoint. And so it matters where you kind of see those much belows or those, temperature forecasts. And who is to say? I mean, it's going to be what it is, but that is what's going on. People are ratcheting that up and down. And the thing is, it's a lot easier to sort of look at that in electricity futures. Number one is that the power pool, the RTO, has a price cap of $9,000. And so that's sort of the guide that people use when they're sort of thinking about their constrained pricing hours, and it's hours in electricity versus days. And the Texas electric system, I think, has like a max capacity, let's say, of 80,000 megawatt hours. And the expectation this past summer, and you'll see even in the futures curve, is that we'll hit that. 78,000, some, max level at certain points during the month of August. I mean, it could certainly be any month. And the thing that's so different about Texas than other markets is that they probably have, I want to say 8 or 10,000 megawatt hours of wind. And so the fear is that we will have a peak capacity day without wind blowing. And so right now, if you look at August futures for August 2019, they settled last night around 178. And beyond that, the rest of the curve is $30 or lower. So for a normal hours, that might even be high. But so using that as kind of a normal clearing price. And then you say, what if we see 7 hours that price at the cap, then we can justify our $175 futures price. And I would say from now until this Feb contract expires, there is going to be a lot of playing with the probability of these constrained pricing days in natural gas. You can see it even here. So let's take Algonquin. So here, the red line is the Boston City Gate, the Algonquin futures curve. And, even up in through, so 2020, right? You still have futures sitting around close to $11, bounces up and down based on other factors. But for the most part, it sits right around, $10, $11 until you get to delivery. And even though this last, December and January have certainly priced in on a daily basis way lower than that, you still have February pricing, I think futures, in Algonquin, February settled around $10.40 last night. That's what I kind of have here on the bottom line, current futures. And if you want to back into that, right, really, if you take 2 constrained pricing days in the Northeast at $100 and then the rest just clearing unconstrained, so I'm just calling it flat to Henry Hub prices at the time I did this, and it's not unreasonable, right? That's fair. We've seen $100 in Algonquin in incredibly constrained time periods and winters and cold stretches. And, you could make that whatever you wanted, 4 days at 50. But it's not out of the realm of possibility, but it is certainly, it's a high case scenario that has happened before. But if it doesn't, and you take that out of the equation, you lose $7 off of this number. And so there is a lot from, in the next 12 days or so where people have to decide, are they going to delivery at these levels? And is there enough information, right? So we're going to get 12 days closer to knowing what February weather looks like. We're also going to have already gone through this next week stretch of cold weather. I think it sort of looks like now the coldest day is going to hit on Monday, which is Martin Luther King Day. So we'll have that information to see how that priced, and we'll have we'll be closer to the actual February window. The other noise thing that's been going on this week is, and trust me, I'm not calling this huge volume or anything like that. A lot of the ETFs that are in natural gas started their roll from the February contract to March contract on Monday. So as of last night, they had 2 of the days down, and they have 2 more to go. And generally those rolls are done at the close of the day at settlement. And so they're selling February and buying March, which, there's a lot of interest in playing Feb, but, being long Feb, short March, instead of having to worry about being long or short out the outright price level as it is. It's really a play that, February is expected to, be the big winter month, and March, the favorite contract to hate. It's funny, if you think Feb, March, I think it's trading 27 cents, 25, 27, February over. And yet the March is like,
about
30 to 40
cents over.
Yeah. And the difference in weather could be equally as dramatic between February and March. The other thing about February is that, with 28 days, it does have a lower percentage of weekends, or what we call off-peak demand days, than March does. So there are kind of like a lot of factors that come into play there. And so that noise is out there. And I think it's kind of screwing. You see, the difference between, a lot of people, look at Feb March spread and March April spread. And there's just a lot of kind of positioning taking place there. And then they're having to slog through all of these ETFs, rolling at the end of the day. So it's like they know that's coming. And so it kind of makes it hard to put any of it on during the day. And again, I'm not saying this is huge volume or anything, but as skittish as this market is, it's certainly at every little signal, people are detecting as something. So I kind of laid out the concept, right, of these constrained pricing days. And so I thought, well, all right, let's look at this winter so far. Look how have cash prices looked, right? So you take November, December, and January, and this is at Henry Hub. And, we started out November in, above 3. We'd made that first move and ended up averaging, a little over 4. And then got into December hanging around, with that cold weather. And then, you can see by the end of the month, we barely hung on to $3 in the cash market as the weather just really turned mild. And so ended up averaging just below $4. And then here, we just completely took a dive below 3 as the weather forecasts petered out even more. And kind of the reality of the storage, the lack of storage withdrawals kind of started to set in. And so as it stands right now, January, through the 17th has averaged just around $3. So if you were to extrapolate that forward and look at February, you'd have to make the case that the weather will be just as mild, because this is not a supply case that we're making on any of these given days. And I say that because when the cold hits, you can have all the gas you want down in the Permian, and you really can't get it to where you need it. You can only get a fixed amount to where you need it. So the minute, right, that we the blue numbers here below $3, you can see that the minute we returned to just even normal winter levels, we saw the market pop right again back above 350. And I think, Mike, you and I talked about that last week. We were saying, the thing is, you can see some of the demand locations. The cash prices there were already starting to pop up. It literally was just a return to regular winter weather from a period of incredibly mild weather. So it's easy to make a case going forward for February if you wanted to line this up and take those mild weather days out and then try to, think about the probabilities of constrained days. And, Mike, when you and I talked about this, I think it's not necessarily how you might have ever looked at this market.
No, this is definitely a new perspective. I like that you're distinguishing between storage that has an impact on prices versus capacity or constraint on a daily basis. And that to me kind of explains price moves like this past Friday as a precursor to a 50-cent rally on Monday. And Friday at about 4 o'clock, I probably shouldn't have been sticking around here, but I just watched Natural just start rallying, and I was quite surprised about that. And you had said because at like 4 o'clock or so on Fridays, there are some new forecasts out. So I was wondering, this Friday, there's still, of course, today and tomorrow, but I'm just wondering, post-close tomorrow, what could happen? Will cash traders, how do they begin to trade that 4-day? Because you said they'll look.
Oh, great point, Mike. Great. So on Friday,
what are they looking at term-wise?
We've talked about this before.
Yeah.
Next day gas trades. Today we'll trade tomorrow between 8 a.m. and 11:30 a.m. And then that closes and moves and rolls to the following day. Yeah. But on Fridays, the market trades Saturday, Sunday, Monday package. When there's a holiday, like there is for Martin Luther King, they will be faced with on Friday having to trade Saturday, Sunday, Monday, Tuesday. And I think I mentioned earlier, Monday and Tuesday, but especially Monday looks, to be the cold day right now in the forecast, or at least over that 4-day period. There's expected to be maybe one of the coldest or colder temp stretches that we've had so far this winter. And so there's going to be a lot of pressure put on people to ensure they buy enough. And always when we come in after one of those holiday weekends that's traded, so when we come into the market on Tuesday, there's always a lot of true up as well, because if you don't get it right, there's pipeline penalties. So, especially for a lot of these power users, so power gen users of gas, there are bands within which you can schedule quantities of gas. And if you fall outside of those, the penalties are pretty significant. And so you see sometimes after this, a lot of buying in the cash market following one of these events or selling to sort of monetize, shore up those imbalances on pipelines. And so you can expect, I would expect, who knows, but I would expect on Friday things to look a little different than they are right now. Coming into this week, we knew we were facing this storage number. And, Mike, you mentioned Friday and into Monday, the market, started rallying.
Right.
The thing is, the storage futures, they didn't change. I mean, the expectation for this week's number didn't really change. The expectation for next week's number didn't really, for that, the one that's through this Friday, right? That will be reported next week. It didn't really change. So we weren't moving. That move wasn't on, like today's inventory number that was coming out. I would say, if anything, it's people, they knew we were going to see this comparable low number today, and we'd have to get through that and then start to focus on this cold stretch that we're going to have, and how does supply demand look during that. So now we've gotten that behind us, right? And, the market likes to read it, as less or more than expectations. For the most part, it's been known for a week, right? What that number is going to be. And now the 155 draw for next week, that'll jigger around a little bit. But, when the actual number hits, the fact that it's 2 or 3 or 5 off really is not the story, right? The story is now, okay, what do we have coming up? And it's always about how close you are to a winter month expiration, especially. This is a much different scenario in the summer, because, we're not in a, production deficit, right? We produce more than we use. So it's just a matter of how much excess do we have to get in the ground and playing cash spreads. But in the winter, we produce less than we consume during certain periods. And so we have to take it out of storage. And there's only a certain withdraw capacity on any given day to take it out of storage. So, it seems, you think, well, that's crazy. Why would, prices go to $10 when we still have gas in the ground? It's because on any given day, you can't get that gas there, right? It has a ratable withdraw capacity. And so you'll take out the most that you can on that day that your contract or the system you're on allows. And that's it. So there's a lot of that going around in the market. And then also, you can take a look at the data that we've had over the winter. And I mean, here's the actual numbers. Here's what Henry Hub, which is kind of the white bars, that's what that looks like so far this year. And, we saw our spike, and then, you kind of have the rest of the ecosystem. The dark blue line is down, in the Permian production area, right? So this point right here is a great example of that November stretch we had where we saw the first big rally above 450. And yet I think that was around the time period we were seeing negative prices down in Texas, or, real close to zero. So, what you conclude about that, right? Here it is. You can't get it there. Well, you can, around this little kind of red line circle, but there's only X amount of capacity. It's not as if there's some unused pipeline all of a sudden that they can start shipping it on, right? It is what it is. And in weather like that, and in such an interconnected pipeline system, flows affect other flows. And so, you think about the electric grid, that's a perfect example. It's just kind of a juiced up, electrified, entire interconnected power grid that has demand and, pulling off of it, and supply dumping onto it. And it has to stay in balance. And so at times when there is maybe too much of a pull in one area due to weather or circumstances, or too much supply dumping onto the grid at another point, the system has to cut flows in order to make the, electrified system stay balanced. And there are some similarities within just the connected pipeline system. There are compressor stations, and there temperatures affect flows. And in order to keep the entire thing in balance, you can't always get it from where you have it to where you need it. And I guess maybe that's even what I mean by, constrained pricing days. It's just, there are limitations, and people are always in the winter pricing up the probability of those limitations. And then just kind of finally, I hope this isn't.
I just wanted to say that I like, you drew a good picture of how this is all integrated. And I took note about capacity constraint was really just a couple days ago on the chat, on the OT chat. I think we were trading about $3.40, $3.45, not really going anywhere. And I was kind of bearish right at that point, I remember. And all of a sudden we're at 365, but you mapped it out. You said there's a good chance we could get to 365, and you showed the math, and I was like, whoa. Okay, and so now I've taken notice of it, and I'm looking at a number of things that you and I discussed before about how that's in fact an embedded option. I think it's worthwhile.
Yeah, also. Right, and yet priced in a different way, right? It has a different kind of decay.
Yeah, and probably Vince or another quant could come on and comment on that, probably more expertisely than I can. But it's interesting because most market makers, Chicago market makers, for instance, when your Greek for time decay is pretty straightforward. This I'm not sure if there's a. I'm sure there's a Greek letter that symbolizes this. And,
right.
Interesting.
Right. That's a little more complex than the little Excel, table that I put up for explanation purposes. Yeah. I think it's interesting in markets like natural gas and electricity, where there is a very robust and active spot market, meaning that the things can look so different from one day to the other. It's so supply, demand, weather dependent that there is as big of a spot market and spot market futures as there is the months. And it seems like in those, you really do have a lot of calculation going into the futures months that is at some level trying to embed like an upside call or a downside put right into into the whole thing. Otherwise, why would some of these months need to price all the way up there, right? I mean, it's definitely building in on a futures curve, right? Because you look at most, there isn't the shape like this to most futures curves.
Right.
I guess gasoline and heating oil look a little bit like that. But yeah.
I think natural gas is unique. I can't think of another commodity that
electricity.
All of this, besides electricity, so the flow of molecules, the flow of electrons. When you're talking about those kind of speeds, you can see how capacity constraint on a daily basis has a real impact. More than any other commodity I can think of.
You got to have it. I mean, you need your electricity right now.
I need that now. So.
It's not like, well, I'll just go get some tomorrow from inventory, and that
real-time,
that real-time nature to it. And, it being such a utility is kind of what makes it, I mean, at some level, even gasoline, when we have hurricanes and the gas stations are out, they're just out, right? And you can't drive, or you kind of limit, or you scarcity price your miles that you drive. It's just that taken to such a whole different level when you get to this. It really, there isn't an option for it to not be there, especially in the winter, because what are you going to have people freeze to death? So unless it's by an act of God, right? There is going to be a price paid to make sure that people are served. So, here we have kind of another look at what, that variability can be. And here's our friend in Boston again, Algonquin, and you can see, how we spiked up again, right? And this, is purely a function, right, of
Yeah.
capacity, available capacity to deliver, prices of alternative fuels. And so markets, if they have that option, right, they'll jump up to the next price fuel out there. And those that are more exposed, certainly you can see that. But it doesn't mean that Henry Hub, with an incredibly robust pipeline system and storage complex in and around the whole system, we've seen that even that system has the potential to, on any given day, have exposure and be vulnerable to the deliverability. This means nothing as far as, wow, it's really bullish for, March, because we'll withdraw a bunch out of the ground, because I don't know what the deliverability is going to look like in March, right? And it seems kind of, around $3-something. We're pricing in a little bit of sort of upside scarcity, and we don't know anymore at the moment. So, this storage number doesn't change that calculus.
Right. In the meantime, I've seen all week real good amount of selling interest and action. Started in FebDs or Cal 19 FebDs and worked its way all the way to April, October, where every day the summer 19 is just a little bit lower and less aggressive bids coming in.
Huh. Yeah. And that summer 19 now is kind of at the high end of its range. So, that's, I don't know, that is, moving up. I guess we'll have to see if there's some fundamentals or it's just merely being pulled up with the front. But I think that's something to keep an eye on. So yeah, just to kind of further the point of, and before we kind of close it up here, unless you have more, Mike, here's this picture of the ERCOT versus the Northeast PJM electricity futures. And you can see in the blue line, this is the strip as of last night for ERCOT, which is Texas. And kind of the brown line is PJM, so Pennsylvania, New Jersey, Maryland. And, here's kind of the estimated total installed capacity. And, why are we sitting here at almost $200 in a futures curve? Because people are pricing in the probability of scarcity. And so I think, that's, as you're viewing these February price movements through, whatever lens you use over the next, I guess, until expiration, I just wanted to throw out there, you can certainly get all the technical indicators you want from, anywhere. And I think those serve to exacerbate or they can serve as magnets.
Right, but that's not really what's driving the market, especially on a daily basis, in my view.
Right.
It's this right here. I hope everyone's...
So when you see these big moves, just think about, what, that somebody is changing their view of constrained days.
Right. And that also explains why, we'll be up 20, down 15, up 10, down 20, from day to day.
Sure, because it's guesstimates.
Yeah.
You can have a great model, you can have great historical data, and you can have a weather forecast, but a weather forecast, is that's your wild card. That's a hard thing to hang your hat on. And so there's a lot of really varying opinions as to what that means. And then there are just people who are just outright bullish and bearish. And that's fine. Go ahead and do that, right? But I like to have a few more things to give me a little bit more conviction around some of the positions I take so I can hold them.
Thanks for pulling off the veil on this. This is fascinating to me.
Great. Well, yeah. It's sometimes all of a sudden I'm like, the way I'm thinking of it, maybe I should just get it out there so that, everybody, can, either poke holes at it but look, I'm not the only one. I guess I'll just say that.
Right.
So, all right. Well, good luck to everyone trading. I hope everybody makes a lot of money in natural gas before this whole winter contract and season winds down. And, hopefully this helped shed a little bit of light on these gappy moves that we've been having the last week or so.
Hey, Brynne, thank you very much. Thanks for the conversation.
All right. Great to talk to you. Thanks, everyone. Have a good day.
Bye, everybody.